Hello everyone, welcome to ixamBee. Please don't forget to subscribe to the channel and press the bell icon. Last week ixamBee had conducted a scholarship test for SEBI paper 2. We got a very good response and the students appreciated the questions that were there, and the successful candidates based on their performance have accordingly got the scholarship. Today in these videos, in a series of videos, we will be discussing the questions and the solutions related that were asked in this test. And also another very important point to note is yesterday PFRDA came out with its results for phase 1, and all those students who have moved to phase 2, these sessions, these questions, discussions will be very helpful for them. In this particular video, I will discuss questions related to commerce and accountancy. You will be able to download the detailed solutions with the questions for your preparation for PFRDA phase 2 and for your future preparation for SEBI 2023. So let's look at the distribution of questions that was there in the scholarship test. The total test consisted of 50 questions with 9 questions from accounts and commerce, 8 questions each of management, finance, costing and economics, and 9 questions from Companies Act. As I said, we will discuss the accounts and the commerce related questions in this particular video. This will be very helpful. Reminding again, there are only 12 days that are left for your PFRDA phase 2 exam that will be held on the 4th of December. So these questions will be a very good revision for your PFRDA exam also. Let's look at the first question. The first question is a numerical based on ratios, where you have been given the balance sheet with information related to equity, preference shares, capital reserve, debentures, creditors and bank overdraft as the liabilities and capital. And on the asset side, you have been given information related to plant and machinery, land and building, investments, stock, debtors, cash in hand and preliminary expenses. Based on this information, you have to calculate the debt equity of the company. The very simple approach is, we know that the debt equity is calculated as your long-term debt or any total liabilities or which has an external obligation for you in terms of interest or fixed return that has to be given, divided by your net worth or the shareholders funds. Debt is very straightforward. The debentures represent your debt over here, which will be 10 lakh. Why do we not include the bank overdraft is because bank overdraft is actually overdrawing your bank limit and therefore is more of a cash and cash equivalent item, and it is not really taken as debt for the calculation of your debt equity ratio. When we talk about the shareholders fund will include different kinds of equity and reserves that the company has. This will include your equity share capital, your preference share capital and your capital reserve. However, there is one more adjustment that needs to be made here, which relates to your preliminary expenses. The preliminary expenses are pre-operative expenses which were incurred by the company before the company started its operations, and therefore they have to be written over. These are considered as capital expenses and are written off over a period of time from the profits of the company. Since they will be written off, they will deplete or decrease the shareholders fund of the company, and therefore while calculating the shareholder funds, they are subtracted upright. As such, our shareholders fund will be a combination of 20 lakh plus 8 lakh of preference shares plus 14 lakh of capital minus 2.4 lakh of your preliminary reserves. Calculating this will give us the debt equity ratio, which will be around 0.25. So the correct answer is C, 0.25. Based on the same data, the next question asked us to calculate the current ratio of the company. Now, current ratio of the company is again a very straightforward, your current assets divided by your current liabilities. Now the question is, what includes your current assets and what includes your current liabilities? Your current assets will include your stock, your debtors, and your cash in hand. Preliminary expenses, as I mentioned, is capital expenses in nature which will be written off, so they are fictitious assets and will not be considered as current assets. Investments, when not specifically specified, will be considered as long term, so we will not consider them as current assets. So this gives us a current assets of 4 lakh plus 8 lakh 20,000 plus 1 lakh 40,000. Our current liabilities include two aspects, our creditors and bank overdraft, which is 4 lakh 80,000 and 3 lakh 20,000. So calculating this, we will get 13 lakh 60,000 of current assets and 8 lakh of current liabilities, which gives us the current ratio as 1.7. The third question was a conceptual question related to the presentation of the financial statements. So the question here was that Divyam Textiles Limited has received money against the share warrants, which will be converted into shares after 2 years at the rate of 1:2. The company received the money so received by the company will be shown in the balance sheet under which of the following heads? Is it shareholders funds, non-current liabilities, non-current assets, or current assets? So here, if we know what our money against share warrants are and how the exactly presentation is given under the Schedule 3 of the Companies Act, then we will be able to solve this very easily. So the share warrants are basically financial instruments that get converted into share at a particular price which is predetermined after the period that has been specified. So 2 years, 1:2 in means that for every share you'll get to every warrant you'll get 2 shares, and the money in advance that company has received will also be a part of your share capital, and therefore this will be shown as your shareholders fund. It is very specifically been given in the part A of balance sheet under Schedule 3 that your shareholders fund will include your share capital, any reserves and surplus, and the money received against share warrants. Any share application money that is pending allotment is shown as a separate item under your equity and liabilities in the balance sheet. Moving to the fourth question, which of the following is true with respect to dividend? Dividend should be declared only out of the profits earned by the company. Capital profit realized in cash can be used for paying dividend. Dividend proposed by the company after balance sheet date is a current liability. Which of these statements is correct is to be identified. The correct answer here is B, A and B. A statement is correct because yes, as per the Companies Act also we know that the dividend has to be paid out of the profits that are earned by the company. So the first statement is correct. When we talk about the second statement B, capital profit realized in cash can be used for paying dividend. Now in general we know that the capital profits cannot be used for paying of dividend, like if we have reserve, capital redemption reserve, securities premium reserve, these all cannot be used, only free reserves can be used. However, if the capital profit, basically capital profit is the profit that you earn not on a regular basis or from the operations of the company, but out of other activities which are long term in nature or once in a while kind of a nature. So such cash profits in general cannot be used until unless they have been earned in cash, which has been given by the ICAI, that if you are actually realized your capital profits in cash. Okay, an example, a very common example of this is when the companies dispose of their fixed assets. So any profit that they have earned on disposing of their fixed asset is reported as other income in the profit and loss statement. So basically it is this kind of a capital profit is routed through your financial statements, and therefore this will be and can be used for the payment of dividend. So statement B although looks incorrect, but actually it's correct. If we go and understand it deeper, when it comes to the third statement, the dividend proposed by the company after balance sheet is a current liability. This is incorrect, because till it is proposed, it is a contingent liability. What is it contingent upon? It is contingent upon the approval of the shareholders of actually declaring the dividend or not. So that's why it is contingent liability. Once it has been declared, then it becomes a liability for the company. Next question. This question relates to your share transactions in the company, specifically related to your forfeiture of shares. So in this question, it was said that the ABC Limited forfeited 200 equity shares of rupees 10 each. Okay, so rupees 10 each is basically representing the face value of the share for non-payment of the first call money at rupees 2. So when the calls are made, first you get the application money, right? After the application money, there can be some allotment money, and after the allotment money, there can be various calls that can be made for money, right? So depending on how many calls are made, they could be first, second, depending on how many calls are made till your final money is received, right? So when the first call, so we are talking about this stage, when the first call was made, this was of rupees 2, okay, and the company forfeited 200 shares because one of the shareholder might have defaulted in or not paid that call. Okay, the company has called up 8 on these shares, rupees 8 till now, right, in the form of application money of rupees 2 and the allotment money of rupees 4, right? So they have called till now total 8, rupees 8, out of what? Out of rupees 10 face value, 8 has been called up till now. Okay, what is the amount by which the equity share capital will be debited in this case? Now we have forfeited the shares, so the question is asking that when we are forfeiting 200 shares, my share capital will be reduced by how much amount? Okay, so here basically what we are forfeiting is what we have asked for till now. So how much has been asked for till now is rupees 8, right? Because rupees 8 is the value by which we have shown our equity till now, right? So I have actually forfeited 6 rupees, but I had asked for 8 rupees. Therefore, my capital is impacted by 8 rupees per share, and because I have forfeited 200 shares, 200 into 8 is my total value of equity that will be reduced. How much amount I have forfeited? I have forfeited is 6 rupees per share, which is 1200. And what about 2 rupees? 2 rupees per share is my arrears. That is 400 is my arrears. So that is exactly what my transaction becomes. So the correct answer here is B. 1600 rupees is the amount by which the equity share capital will be debited. And as I said, forfeited shares will be 1200 and 400 becomes my calls in arrears, which is not paid. Next question, question 6 was a conceptual questions related to break-even point. Is the level of EBIT. Now you may get confused, why is this an accounts question and why not a costing question, right? So break even, when we are talking in a company's performance sense, break even also refers to the level at which the company is recovering all kinds of costs, right? So we are not only talking about the costing aspect. This is also a financial and accounting concept related to your financial statements, which tells at which level the company is recovering and is becoming operating break even. and the other is a financial break even. When we're talking about financial break even, basically it is saying that apart, not just related to your product, but overall while running the company, the other various costs when we are able to recover. Remember, in cost sheet, when we are talking about cost sheet, we don't include costs related to interest payments and all, but this is talking about the company's financial performance as a whole, right? So in that case, my EBIT, remember what is EBIT? EBIT is your earnings before interest and taxes, right? So my financial break even actually comes at a point when all my financial fixed costs get covered by my EBIT, right? So what are my financial fixed costs? My financial fixed cost includes interest payments or any kind of preference dividend that is promised. Okay, so that becomes my fixed financial cost, and therefore when my EBIT is equal to my fixed financial cost, which includes interest or preference dividend, that is when I break even as an entity on a financial level. Okay, so this is also explained with the help of an example here. Next question was a numerical related to depreciation topic. Here some information was also given that was extra to confuse, right? So we were given the cost of the assets as 4,50,000, useful life as 7 years, depreciation rate as 10%, salvage value as 30,000, and we have been asked to calculate the depreciation for the third year on a straight line method, right? So it is very important which method is being used. So it is a straight line method, and in straight line method we know that the depreciation is same in all the years, right? And here we see whatever is the amount that the company is consuming, that we divide by the useful life, right? So what is the amount of the asset? It is the 4,50,000, which is our cost, minus the what we could get or salvage, that is 30,000, this divided by the useful life, which is 7 years, right? So solving for this will give me 60,000 per year. That will also be my depreciation for the third year. So the information here, 10% is not useful. If instead of straight line method we had to choose, right, the written down value method, in that case the third year amount would differ, because I will be depreciating by 10% every year on the written down value, the carrying value. Okay, so as I said, the correct answer is D, 60,000. Next question is ESOP based question, but it was a simple conceptual question, that if an employer gives an option to employee to get 500 shares at ₹40 each after the vesting period, it is known as which of the following settlements? Is it equity settled, cash equivalent settled, mixed settled, or capital gain settled? The correct answer is equity settled. In equity settled, what happens is, whatever the benefit is, the company is giving you shares of the company. Okay, so here as we are saying that the company has given the option to the employee to get the shares, therefore it is equity settled. However, in cash settled, what happens is that whatever is the profit or the gain that the company is getting based on the shares value, that is given in cash form or a bank transaction to the employee. That becomes a cash settle. So instead of giving the shares, whatever is the gain are coming out of the basis of those shares, that is given as the benefit. Okay, and then there can be other cash alternatives also that can be used to make the settlements. Last question of accounting from this segment it was also a numerical based on the inventory concept. The question was about a company which started in 2021 with nil inventory. Okay, so we know that the opening inventory is 0. Okay, during the year it made purchases of 50 lakh, of which 75% was sold, right? So what was my unsold, which becomes inventory? Okay, that is 25% of 50 lakh, right? So that becomes my inventory now, right? The company can sell the remaining inventory for rupees 13.5 lakh after giving a trade discount of 10%. What will be the value of the closing stock? Okay, so I know that the cost of my unsold inventory is 12.5 lakh, right? Because I had purchased it for 50 lakh and 25% of that is left. That means 12.5 lakh is the value or the cost of my inventory. Okay, now the accounting standard related to inventory states that the inventory should be valued at lower of cost or NRV, right? So I know my cost. Now I need to know my NRV. What is NRV? NRV is the net realizable value. That means how much I can actually get by selling this inventory. So I have been told that this inventory can be sold at 13.5 lakh. 13.5 lakh. So is this my NRV? No. Why? Because I cannot sell it at 13.5 lakh. I will be able to sell it for 13.5 lakh only after giving a 10% discount. So I will less 10% from this. Okay, so that is what I have to reduce, and once I reduce that, I get a value of 12.15 lakh. That means the lower of 12.5 and 12.15 is 12.15. Therefore I will be able to value my inventory at NRV here, which is 12.15 lakh. So that's all for the questions from Accounts and Commerce. Please stay tuned because we will discuss similarly questions related to the other subjects, and in the end I will discuss some more questions related to the pension sector, especially for PFRDA preparation. ixamBee has come out with a 50-day study plan for SEBI 2023 because the exam dates are nearing. So Sheel sir has already told the SEBI exam will happen in the last week of January 2023. We are starting a new batch on the 1st of December, and the intro class will be held on the 1st of December by Sushil sir and myself, Prachi Agarwal. These questions and discussions will continue for your PFRDA exam also, which is on the 4th of December. You have only 12 days if you want to avail the course to be able to practice your paper 2 and paper 1, which is descriptive English, and will consist of a lot of practice for your descriptive English and personalized checking and feedback. So if you are interested in this complete course, which will be in addition to all the content that is also available for you to revise through crisp notes, short videos, and a lot of practice tests, you can avail the course at a flat 42% discount. You can contact us on the number given on your screen, 920-552-4028. Please don't forget to download the accounts PDF so that you can look at the questions and the solutions and practice for the exams. Thank you, everybody. Don't forget to subscribe to the channel and press the bell icon. Prepare 50% faster with ixamBee for your SEBI and your PFRDA exam. Thank you.